Hey there, macro folks. This is Mr. Hooker, and today we are going to start chapter 7, which is all about GDP and the CPI. So, two of the big three right here, all in one chapter. So, let's see how we're going to track this macro economy. Um, so, there's that piece. So, GDP is really all about what we call the national accounts, which is as close as we as economists get to accounting. This is how we measure the key aspects of the economy. We use national income and product accounts, NIPA. Um, so what we just call the national accounts, because hey, that's a lot shorter, right? Um, so they keep track of all the spending of consumers, sale by the producers, the business investment spending, the government purchases, and the money that flows between all the different sectors there. So this is what the circular flow looks like if you were to throw everything in there. So if you remember the nice simple circular flow that had four things in the very beginning, you understand how this one is terrible. SERP models are supposed to be simple, not complex. This has everything in it. This is what we call the complicated circular flow. It's also known as a bad model. It's just a little too complex is the way this thing goes. So you could get everything you needed from the other one, this one, because everything that the other one had are these things in the middle. Let's see, where's my cursor? Right there. Oh, right there. So there's households, there's firms, there's the factor market, there's the market for goods and services. So it was just these things. And now we've added a financial market, the government, and the rest of the world. And so all of that on the outside is new. Do you really need it to understand how the world works? Probably not, but there it is. So now consumer spending is household spending on goods and services. Government purchases goods and services are total expenditures on goods and services by federal, state, and local. Investment spending is spending on productive physical capital like machines, construction of building, changes to inventories. Talk about that later. That gets kind of confusing sometimes. Goods and services sold to other countries are exports. Goods and services bought from other countries are imports. Um, if we add them all up, we get the market value of that, and that's the country's GDP. All right, so when we look at this, goods and services are final if they're sold to the final or end user. Goods and services are intermediate if the purchaser or some other firm is not the final user. So basically, when you buy a car, the car is the final good. So you expect that that car came with tires, a windshield, all that stuff, windows. Now, wherever they bought the windshield from or the tires, whatever brand, Continental, Michelin, like that, they sold them to the car manufacturer. They put them on the car. When they were sold like that, they were intermediate goods. Now, if you ever have to go buy another windshield or new tires, those are final goods. Again, when you are putting them on the car yourself, it's kind of a weird thing, but not terribly. GDP or gross domestic products, total value of all the final goods and services produced within the country during a given year. So that is the GDP thing. So everything that we make within a given country. So it doesn't matter who makes it. It'd be a Japanese firm, a German firm, a Mexican firm, doesn't matter. They made it in the US, it counts to US GDP. If you're looking at Germany, if it's made in Germany, it's German GDP. If you go to Mexico, you look in, if it's made in Mexico, it is Mexican GDP. If you go to Canada, if it's made in Canada, it is Canadian GDP. Doesn't matter who made it, it's just about where, which is so much simpler than GNP, which is gross national product, which ended like 1992, I think. 1992, I think it was. Um, which that was about who made it, not where it was made. So GDP can be calculated three ways, which really it's two ways. because 2 and 3 um, are basically the same. So 1 is what we call the expenditure method. Total value, you add up the total value of all final goods and services produced. So that is called the expenditure method. 2, add up the aggregate spending on all domestically produced final goods and services. That is the, uh, well, I guess that's the, uh, okay, so that is kind of different. I take that back. So that's the expenditure method. The value, you're not actually looking at the spending. You're just what is everything that was produced and you're taking the value of it. That's a little bit different than what I've ever seen because it has to have been sold. Or no, because it doesn't. So that's a little bit different. Add up the total factor income earned by households from firms in the economy. That is the income method. So 2 and 3 are very different in the sense that, or should be the same. Let's say it that way. Um, so, they say it doesn't matter if we add up all the spending or the income because one person's spending is another person's income. Um, and that should be true, right? So if I buy $5 worth of goods from you and I hand you $5, I spent $5, you received $5, it should be reported as $5. However, we typically just use the expenditure approach. That is what is reported. We do not use the income approach. And the reason is the income approach has a statistical discrepancy larger than the Powerball. Uh, just to put it this way, if I ever find the statistical discrepancy, you will never see me again. I will not report that I am not coming into work. I just won't show up. I will buy an island, move to said island. No one will ever hear from me again. I will not have a phone. I won't have anything. You will never find me ever again. That is the way that works out. And honestly, if any of you ever find the statistical discrepancy, I expect the same respect from you. I expect you to just disappear. That thing is like $600 billion, something like that. It's insane. Um, that's what it was last year, I think it was. All right. So yeah, if you find it, I got nothing against you just disappearing. Just have fun with it. Enjoy your life. Um, calculating GDP, it's pretty simple. What we're basically going to do is we've got 3 firms. We can add the value of the final goods and services, add the spending, or add take the factor income, the value of the sales, National Ore, National Steel, National Motors. We can basically add the value of all of those. Uh, if we do that, basically we're looking at what was the final good that was produced. It was a car. So the final value of all of that was 21,500. That's the final good. If we do uh, the value of the production, so you see down there at the bottom, value of production of final goods and services sums up to 21,500. The second one, actual aggregate spending on domestically produced final goods and services, is up at the top in the third column, 21,500. Total payments for factors, wages, interest, rent, profit, total expenditures by firm is 21,500. They made this really nice and simple, but it does not look like that in the real world. All right. Measuring GDP is the value of production of final goods and services. Add up the value of all final goods and services produced by the economy. Only each producer's value added is calculated. So the difference between the value of its sales and the value of its intermediate goods is what you're doing. So just what they added to this. The Europeans do this pretty well. They hate the value added tax, but they do calculate value added pretty well. Um, so we don't want to count intermediate goods because that would cause us to count the same items several times. So to do that, we only count their value added in the calculation. To do spending, we add up all the spending on domestically produced final goods and services, the sum of the consumer spending, investment spending, government purchases, and exports minus imports, which are known as net exports. Um, Count only the value of sales to final buyers and omit sales of inputs from one business to another. And that's kind of how we do. So it becomes C plus I plus G plus X minus IM. Uh, so that's how that works out. So the X is exports, and the M is imports. So you could combine those two and make it an NX, net exports, but that's it. But this works the way they got it. It works out fine. Now, that C is also that piece of in the circular flow, the money that flows from households to product market. That is C. So there is that. So let's, factor income, GP is factor income earned from firms. Add up all of these, the wages earned by the labor, interest paid on your savings, the rent earned by those who lease their assets, and dividends paid to shareholders, um, profit as well. So all of those go that way. So let's go to this. I forgot to pull it up, so we'll just do this right here. So this is the BEA website. It is bea.gov if you want the actual address. Um, so actually, I don't have time to do all this. So what we're going to do is we're going to stop right here and I will start with the BEA website in video number 2. All right. I will see you in video number 2 on this, and we will do the BEA website, which is breaking down GDP. Take care, folks.